Hi, everyone. It's Andrew Johns here. It is March the 10th, Tuesday morning, with a market update for you. I want to start by talking about the equity markets. There's been a huge amount of gyration going on in the equity markets over the last 2 weeks with the proliferation of the coronavirus globally. As of last night, the Italian government has shut down the entire country on lockdown from travel. And there's cases continuing to expand globally, and this is obviously having a major impact on the equity markets. So I want to speak to you for a moment about what's been going on. This is a 1 month graph of the Dow Jones. If you take a look at the Dow Jones, it peaked out here in the 12th of February at just short of 30,000 points. It had its largest single day of drop of points, over 2,000 point drop yesterday, matching or close to that of the Black Monday date in 1987. We've had a little bit of a recovery today. The market was up almost 900 points earlier this morning, currently up about 400 points. So we've seen a massive drop. This is your 1 month graph, and then here's your 5-day chart. And you can see just these massive drops. Here's the big drop that happened between the close on Friday and the decline that happened on Monday. For those clients who are investing in the equity markets today, my advice to you is you need to have a plan. If you didn't have a plan, it's time to get a plan. If you had a plan, stick to your plan. This is all about making sure you maintain a steady hand and have a strategy that suits your needs. If you're an elderly investor, I'm going to talk in a minute about the fixed income sector and how that might affect your portfolio. But if you're an elderly investor, this is not the time that you should be taking on risk. If you're a young investor, I believe you've got a gift being handed to you right now with an opportunity to start to at least enter the market. I don't know if this is a bottom. You're never likely going to pick the bottom. But the most important thing is making sure that whatever your investment portfolio is designed, it's designed in a way that makes you be able to sleep at night. Now, I want to point out one company in particular that I think is really compelling. This is Royal Bank of Canada. Of course, this is not a blanket piece of advice. You have to consult with either somebody from my team or your own financial advisor before you make a decision of this, because this is only one stock and I don't know how it fits within your investment portfolio. But let me give you an example of how compelling the market is right now for valuation on certain equities. Now, would I be buying oil and gas service companies? Absolutely not. Would I be buying a cruise ship company? 100% not. And that's why those share prices are down well over 50% in some cases. But there are certain companies that are being, in my view, unfairly treated. Companies that have incredible balance sheets and very strong earnings potential, even during a period of maybe a mass pandemic that we could potentially see here globally. So I'm going to speak to, for example, a company like Royal Bank of Canada. Right now, Royal Bank of Canada has a dividend yield of 4.8%. We're closing in on a 5% dividend yield. The last time we saw a dividend yield close to this level was during the financial crisis, when it reached up to a high of, I think, around 7 or 8%. My memory may be a little bit off there, but this is historically, from a 20, 30-year perspective, a very, very high dividend yield. Here's the 1 month chart on Royal Bank. You can see the share price is just being carved here from where it was at a peak just a few weeks ago. It had reached a high of 109 and is currently trading at $90 a share. There are many other companies like this, and I'm just going to use this one as an example, where investors can lock in a dividend yield right now that is very compelling. And if you're a Canadian investor, of course, this is even more compelling because of the tax treatment on certain eligible dividends like those from Royal Bank. General rule of thumb, if you want to do the math, is to compare dividends to interest income, is to take whatever the dividend income, and this is, of course, assuming that you're a high-taxed individual in Canada, but the difference is, of course, is the tax treatment between the two. So you take your dividend income and you multiply it by 1.4, and that gives you roughly what you would earn in interest equivalent. So right now, if the rate is I'm actually going to pull it up on here with my calculator so you can actually see it on the screen. If you take the 4.8% and you multiply it by 1.4, you can see that this is an interest equivalent of 6.72%. GICs, just to give you a perspective right now, a 1-year GIC is closing in on the 1% level, 1.5% level. So this is a solid 500 basis points higher than what you would get on a GIC. Of course, the risk parameters are very different. You have to be prepared to take on the fact that these share prices could drop significantly further, whereas something like a GIC gives you a full guarantee. But for those people who have the patience and the fortitude to be able to work themselves through a tough equity market, you have a phenomenal opportunity in front of you right now. Now, talking to GICs, let's switch gears and talk about the fixed income market. For those investors, pardon me, whether you're a retail investor or you're an institutional investor, if you didn't have a plan, like my message before to those equity investors, you got to get a plan into place today. This latest events that have happened over the last coming weeks with the decline in interest rates, the dropping in the yield curve, to me speaks directly to the value of having an investment strategy and not just trying to capture whatever the highest rate is in the market. We are in a rate declining environment, and under that environment, I often speak to the rationale or the strategy of a yield preservation versus yield maximization. So let me start by showing you a little bit of a history here. This is the U.S. I'm going to talk about the U.S. market, and then I'm going to parlay that into the Canadian market. This is the U.S. Fed funds overnight rate. You can see going back to 2007, the overnight rate used to be just above 5%, back when we so-called had a normal market, although it's been over 20 years, so I don't know if that we're back in where this will ever be a normal market again. I said 20 years, sorry, about 13 years. We saw the financial crisis occur during this period here, and we dropped all the way down to basically a 0% Fed funds rate. We never got into negative interest rates in North America. All the Europeans did, and they continue to retain these negative interest rates, and we'll talk about that in a minute. And then starting in 2016, the Federal Reserve started finally raising interest rates in this rising rate environment when the economy continued to boom, people were fully employed, and inflation seemed to be relatively in check. And then we can see here this decline in interest rates starting to happen in the latter part of 2019 and going into 2020 when there was an emergency half-point rate cut by the Federal Reserve just last week. Where is that going to go from here? This is the current probability rates, and what we're looking at is the next Fed funds meeting is going to be taking place on March the 18th in exactly 8 days from now. The market is currently pricing in a 75 basis point cut. We are heading to zero interest rates, and we are very likely heading into negative interest rates in the U.S. market. One of the things that we've been noticing on a product side is the high rates of returns relative to where the rest market is today. High rates of returns on what you can get for your 90-day money and the lower rates you get on 1 year. And what I'm reminding my clients of is the reason the banks right now are providing these sort of I call teaser rates on 30, 60, 90-day money and overnight rates is because they actually, as an investor, they don't want you depositing money with them or buying their in securities that are going to go out for 6 months, 9 months, or a year, because in the end, it's probably going to cost them more. And this is the same on the both Canadian and the U.S. side of the equation. So we are anticipating at this point another 75 basis point rate cut in 8 days from now, and the market is pricing in by June, perhaps, perhaps another rate cut of another 0.25%. So in my view, we are definitely heading to a zero rate environment and very likely a negative interest rate environment, and that's reflected in the yield curve. So what you're looking at here is blue is where we were in March of these dates are incorrect. This is going to be, I believe, March of last year is blue. The red one here is just from 3 weeks ago, and then gray is where we are today. So you can see this massive drop because of the rate cut by the Federal Reserve, and look at how flat this yield curve is. You got to keep in mind, this is 0 and this is 1%. It looks like there's a lot of movement, but there's only 1% difference between here. This is about as flat as the yield curve I've ever seen. You've got rates right now paying on a 1 month overnight with the Federal Reserve of just over 0.5%, and the 30-year actually dipped down yesterday below 1%. So we are past the point of investors believing that for the next 30 years there won't be an inflation. I think most investors believe that there will continue to be 2 to 2.5% average inflation over the next 30 years. So you'd ask yourself, well, why are bond yields in the States yielding below that inflation level? And it's because of the fear that things could get much, much worse. This is a very good gauge. The bond market is often a very good gauge of how much fear there is in the market. Where do we go from here? Here's a 5-year yield curve. You can see also very, very flat. The gray is where we're at today. The bottom line is, if you're an investor with US dollar funds, if you're an investor with Canadian funds, you want to focus right now on capturing a decent yield for as long as you possibly can stomach. So we recognize that liquidity constraints are very important for liquidity and for short-term cash investors. But the further out you can push your investments, probably in the end, looking back, you'll be better served. So don't worry about necessarily capturing the very best rate, but focus on trying to get a decent rate for a longer term. Let me give you some very specific examples. If I was using my own money and I had a choice between a US rate that was paying me, for simple math, 1% for the next 90 days or 0.8% for the next year, I would take the 0.8% for the next year. The simple reason is because we're expecting a 3/4 point rate cut in 8 days. And so that 90-day rate at 1% only is attractive for the next 90 days. And when it comes up for renewal, you might be looking at new rates that are near zero. And don't kid yourself, we could get into a negative rate environment. It's been happening in Europe for almost a decade now. So it's very plausible that within a year's time, when you're rolling your US funds, you might be rolling them at a negative rate. What does that mean? That means that you're going to be paying the Federal Reserve, if you keep your money in T-bills, or the banks, you'll be paying them for them to keep your money. Let's jump to the Canadian market. The Canadian picture doesn't look too different from the US one, and we anticipate very similar results. You can see here that the Canadian Central Bank had actually raised interest rates shortly after the financial crisis, lowered them during the 2015 period, and then back again started a rate rising environment in 2000 and started mid-2017. And then, of course, there's been a half-point rate cut by the Bank of Canada in their meeting they just had last week. Currently, the market is anticipating a near two tranche cut, or a 0.5% cut in the next meeting on April the 15th. Almost for certain at least a 1/4 point cut. And when we get into July, the market is anticipating at least another 0.75% coming off the overnight rate with the Bank of Canada. So if you're a borrower, if you're a mortgage holder and you've got renewals coming, what a great opportunity for you. If I was renewing my mortgage, again, you got to consult with your mortgage advisor and your tax team, but I would say right now variable rate mortgages are the way to go as rates continue to drop. Here's your yield curve on the Canadian side. We can see here blue is where we were a year ago, red is where we were only 3 weeks ago, and gray is where we are today. Again, very similar yield curve. Take a look at the difference between the two. You've got a rate range of 0 to 1%, and basically the line is flat from 1 year all the way out to 30 years. And then if you look at the Canadian one, same story. 0 to 1% is this bandwidth here, and basically from 3 months all the way out to 30 years, it's below 1%. Here's your 5-year yield curve. So for those investors who are investing, our institutional clients who are investing in more short-term cash investments, you can get the picture here. The rates are declining. This is why when you look at a 3-month Bank of Canada T-bill rate at 64 basis points versus a 1-year at 54, we have an inverted yield curve, implies there's a recession coming and rates are going down. This is why I continue to pound the table on a laddered portfolio, longer-term investment strategy, push out. We have clients who thankfully many years ago started rolling out their portfolios as far as a 2-year laddered strategy, and those clients are very happy with those results today. That's it for our suggestions, for our recommendations for today. We'll continue to give you an update. If you do want more insight, give our team a call. We're happy to speak to you and give you some suggestions, whether you're an equity investor in the private wealth space or you're an institutional investment manager in the cash management space. Thanks for listening.